Well, people, what we are witnessing here is the ultimate classical magic trick that the Federal Reserve has pulled before, trying to make us believe that a tiny decrease in core inflation means that everything is okay. Let's not kid ourselves. While on the surface the latest core inflation numbers may look positive, there are deeper cracks to be found in the underlying system. We're looking at a situation that exposes significant economic challenges, the kind that central banks and government policymakers are trying hard not to talk about, at least not too loudly. And while they celebrate those tiny improvements like cutting a ribbon for winning the battle, the truth is, the broader economic environment is anything but rosy. Now, let's break it down piece by piece. We'll satirize a few key points, exposing how these decisions, layered on top of pre-existing cracks, reflect a much greater struggle, one that might lead the economy into deeper trouble if handled improperly. This is not just the talk of pessimists, we've got numbers, precedents, and forecasts that are far more convincing than rosy-sounding government statements. The latest data from the Bureau of Economic Analysis, BEA, shows that the Core Personal Consumption Expenditures, PCE, price index, which excludes volatile food and energy prices, rose by 0.1% from October and by 2.8% year-over-year. Some folks in the media are treating this like an early Christmas present. Fed officials like John Williams and Mary Daly are breathing sighs of relief, indicating that it falls in line with their expectations of cooling inflation heading into 2025. But let's remove the bureaucratic rhetoric here. The modest 0.1% monthly advance is being touted as progress, and sure, compared to the far more concerning months we've had before, it is better. However, what is being ignored is that this figure is not reflective of deep, structural changes in the economic climate. Remember, inflation has stalled in recent months, forcing the Federal Reserve to forecast higher rates and inflation projections than initially anticipated for 2025. Just because we see a slowdown in month-to-month rises, it does not mean that the overarching inflationary pressures have magically dissipated. We still live in a world where energy prices, supply chain disruptions, and a whole lot of external forces remain wildcards that could quickly turn this scenario upside down again. Ah yes, Treasury yields and the mighty dollar remained under pressure after the release. The S&P 500, always looking for an excuse to climb, saw a modest uplift. It's almost as if markets are pretending everything is fine. The problem? We still have a very fragile economic system propped up by artificial tools like quantitative easing leftovers and interest rate interventions. These aren't long-term solutions, they are merely ways to cushion the inevitable pain that comes after years of fiscal mismanagement. Let's not mince words, inflation slowing a bit month on month, particularly in core services prices, which rose only 0.2%, the slowest pace since August, doesn't change the fact that this is selective deceleration. We're staring down the throat of more volatility in energy markets, uncertainties in global trade relationships, and the residual pain that COVID-19 started, but which hasn't fully dissipated. Take, for example, housing costs, one of the biggest pressures on American citizens. Real estate inflation still looms tall. Let's not even start on energy markets. Sure, housing and energy markers were excluded from the latest PCE numbers, but you can't just sweep these elephants under the rug and pretend they don't exist. Household real estate and rent inflation remain under severe pressure, with property prices still largely unaffordable for the majority of first-time and lower-income buyers. Combine this with high-rate mortgages, and we see quite a grim reality: people are burning through savings and getting tied up in higher debts with few ways out. As we move into discussion of interest rates, here's where things get even more complicated. Fed Chair Jerome Powell and company are predicting 2 rate cuts for 2025, which certainly sounds nice on paper. New York Fed President John Williams is enthusiastically optimistic about moving the benchmark rate down towards some mythical, neutral level, and San Francisco Fed President Mary Daly seems almost smug in agreeing with this trajectory. But cutting rates is no panacea in this scenario, far from it. Let's consider the real reason why inflation became a problem in the first place: massive pandemic-related stimulus, which, by the way, everyone seems to conveniently forget, and supply chain disruptions, exacerbated by geopolitical tensions like the war in Ukraine and trade battles with China. That inflationary spike wasn't just some random occurrence, it stemmed from inherently bad policy practices balancing on an already fragile recovery. Would rate cuts really save us from falling into stagflation or, worse, a deep recession? History says otherwise. Also, let's talk about the illusion of consumer resilience. We get it, spending rose 0.3% in real terms in November. And sure, that may seem like a triumph, considering the headwinds the economy is facing. But dig a little deeper, and you'll see that much of this came from car purchases and the holiday shopping season. It's a pattern we see every year, and it's not indicative of a broader, sustainable trend. Speaking of spending, yes, wages and salaries went up by 0.6%, the most since March, meaning people have a little more money in their pockets. However, have we really looked at where that money is going? Real disposable income only rose 0.3%, largely because of weaker investment income, e.g., dividends, and reduced government benefits. And with inflation continuing to gnaw on any wage gains, ordinary Americans are not exactly pocketing excess savings. Rather, they are spending more just to maintain their standard of living, a precarious situation at best. Ah, the government's love for metrics. When the economy expanded faster in Q3 than previously thought, they wasted no time praising this as a sign the worst is over. But is it really? Let's not forget that much of the growth is driven primarily by ballooning consumer debt. Credit card borrowing continues to pile up, and delinquency rates are starting to creep higher. With high inflation in daily essentials, student loan repayments being reinstated, and stagnant real wage growth, what we are seeing is that the average American household is financing their expenses through debt rather than any true real wage improvement. We now have an unprecedented situation where American consumers are holding the heaviest cards of all time, credit crises anyone, while corporations bloat their balance sheets with stock buybacks and pay dividends to a joyous pile of mostly unaffected shareholders. Meanwhile, we have Wall Street and government agencies who seem blissfully unbothered by the long-term ramifications of all this. Going forward, as we stand on the cliff of 2024 transitioning into 2025, the truth is, we are walking a tightrope. Sure, we might see a Fed-induced reduction in rates, but is that really going to solve the fundamental issues? Spoiler, no. Rate cuts might temporarily ease credit conditions, lift asset markets, and generate a deceptive perception of recovery. However, this doesn't fix the fact that structural inflation issues like supply chain disruptions, geopolitical instability, and regional labor discrepancies haven't been handled. Nor does it cure the long-term economic over-reliance on debt-fueled consumption. Indicators like wage-salary growth are unreliable yardsticks when contextualized against massive increases in cost of living, unaffordable industries, housing, healthcare, and sustained inequality that keeps the majority struggling while the wealthiest keep getting proportionally richer. In summary, folks, the Fed wants us to relax and enjoy an incoming potential rate cut party in 2025. But the hidden economic pitfalls lying underneath are far darker than they want to admit. If policymakers miscalculate, again, we might be looking at the economic equivalent of repeatedly patching a leaking boat, without addressing the actual gaping hole at the bottom. We owe it to ourselves to take a sharper lens to these cherry-picked inflation numbers and critically assess whether the fundamental drivers of the U.S. economy are being addressed. Hint, they're not. Expect more volatility as short-term progress burns out, revealing that the country remains vulnerable to recessionary shocks, internal and external, unless smarter, more structural reforms take place. Stay tuned as we delve even further into whether 2025 will bring relief or disaster, with more deep dives into the medical bills no one wants to pay, healthcare inflation, the housing market that's borderline breaking your back, and more global events that could send even more wild shivers through your wallets. Is the recession really avoided, or have we delayed the inevitable crash?